In today's episode, I'll talk about three interesting stories. I'll first talk about how the electronics and manufacturing services space in India looks like. Then I'll discuss some interesting details from how the mineral sector looks like. And finally, I'll talk about ITC India's Limited's quarterly results and what that tells us about different sectors in India. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. Today is Monday, 28th October, and for today it's me, Bhavya Dua, who is going to be your host. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. And if you prefer video, you can listen along with interesting charts on YouTube. The Daily Brief is also available in Hindi, and yes, you will find me narrating today's episode there as well. And if you like reading instead of watching or listening, you can sign up for our new spam newsletter for a quick rundown. All the links are in the comments. So let's start with the first story and talk about how Dixon Technologies' quarterly results give us an overview about the electronics and manufacturing space in India. The interesting thing about this was that even though the company reported a massive 263% jump in its consolidated net profit, its stock took a surprising hit and dropped nearly 7.5% in one day. You would naturally think strong profits would make investors happy. So why the drop? Well, here's the thing. Sometimes markets have sky-high expectations, especially in sectors like electronics manufacturing, which have been booming. Now, investors may have hoped for even more, or they could be cautious thinking other players in this space might soon post even higher results, making Dixon's achievements look ordinary by comparison. So, while the numbers are good, this reaction tells us a story of a market that expects a lot more from the electronics manufacturing sector. Now, let's take a step back. The electronics industry has become an essential part of our lives. Just look around. Smartphones, laptops, smart TVs, wearables, electric vehicles, all of these things are powered by electronics. Imagine your life without them. It would be tough to get anything done and even listen to our daily brief on a daily basis. But here's something that's often overlooked. While we rely heavily on these gadgets, India produces only 2% of the world's electronics, but we consume 5% of it. That's a big gap. And the way we are filling it right now is through imports. To put it in perspective, in 2023, India's electronics imports touched $76 billion. It's our second biggest import category after crude oil. Now, this dependency means that whenever there's a disruption in the global supply chain, like what happened during the pandemic, India is hit hard. However, the good news is that India is taking steps to change this, and the goal is not just to reduce imports, but to become a global exporter of electronics. Let's address this first. Right now, about 27% of the electronics we use are imported. Key components like semiconductors, printed circuit boards, which is PCBs, and displays mainly come from outside the country, with China supplying about 44% of these imports. Now, in financial terms, we are talking about 3 lakh crore rupees worth of electronics imports in financial year 2022. This heavy reliance doesn't just impact our trade balance, it also makes us vulnerable to risks beyond our control, like geopolitical tensions and supply disruptions. But the situation is improving. By financial year 2028, it's estimated that our dependence on imports will fall to around 16%, with the total import value expected to decrease to about 2 lakh crore rupees. Meanwhile, exports are set to grow substantially. Exports currently make up just 1% of our electronics production. But this figure is projected to grow at an astonishing 44% compounded annual growth rate, reaching 11 lakh crore rupees by financial year 2028 and making up 39% of the total electronics production. Now, this signals a big shift from being a country that mostly buys electronics to one that manufactures and exports them. But how is this really happening? What's driving this change? Well, the government has rolled out several initiatives in recent years to boost domestic production and attract global investment in electronics. Let's go through the major ones. Number one, Make in India, which was launched in 2014. This initiative aims to turn India into a global manufacturing hub by encouraging both domestic and international companies to set up factories here. Now, special funds have also been allocated to support mobile phone and component manufacturing. Number two, Phased Manufacturing Program, which is PMP. Now, through import levies and duty exemptions, this program incentivizes local production of electronics. Initially, it was focused on mobile phones. It is now expanding to cover other electronics too. The next one is Production Linked Incentives, which is PLI scheme. With a budget of 1.95 lakh crore rupees, this scheme incentivizes incremental investments across 14 sectors to boost production, scale up, and make India competitive on a global level. The next one is the SPECS scheme, which is the SPECS scheme, which was launched in 2020. Now, this scheme offers a 25% capital incentive for local manufacturing of electronic components and semiconductors, making it financially attractive to set up production. The next one is the Electronic Manufacturing Clusters, which is EMCs. Now, these clusters provide infrastructure and facilities where multiple manufacturers and suppliers can work together, creating efficient, collaborative manufacturing hubs. Semiconductor and Display Fab program is another one. With 76,000 crore in funding, this program aims to create a local ecosystem for manufacturing semiconductors and displays, which are critical components for most electronics. Now, the next one is a Merchandise Exports from India scheme, which is MEIS. MEIS rewards exporters, offering incentives that can be used for customs duty payments, helping Indian electronics manufacturers compete globally. India isn't just attracting manufacturers because of these policies. There are other reasons as well. Well, let's look at them. The number one is the lower labor costs. Labor costs in India are slightly lower than in China, which makes it cost effective for companies to set up labor intensive operations such as electronics assembly here. Number two is ease of doing business. India's ranking in ease of doing business improved significantly from 142nd in 2015 to 63rd in 2020. This makes it easier for companies to start operations here, and it's a big plus for foreign investors. The next one is young workforce. India has a large pool of young, skilled workers, which is crucial for the manufacturing industry. Now, with millions of people entering this workforce each year, companies find it easier to meet their talent needs. And these changes are already attracting some big names. Apple, for instance, is currently making about 5% of its iPhones in India, but plans to increase that to 25% over the next few years. Foxconn, one of the world's biggest electronics manufacturer, is planning to expand its investments in India fivefold by 2026. Micron is also setting up its semiconductor plants in Gujarat, making a major step in India's ambition to make its own chips. Samsung is even producing 5G equipment here and is expanding into laptop manufacturing as well. Even Google has plans to make Pixel phones in India to diversify its production. Now, these moves show that India is quickly becoming a crucial part of the global supply chain. It's not just about moving away from China. It's about building India as a global electronics manufacturing hub. However, let's be realistic. There are challenges that exist as well. Right now, the value addition within India is still relatively low at about 15 to 20%. That means while we are assembling products, critical components like semiconductors and PCBs are still mostly imported. Now, the goal is to increase the local value addition to 35 to 40% by financial year 2030. To do this, India needs a stronger local supply chain, more R&D investment, and advanced manufacturing facilities. Additionally, there's also a need to upskill our workforce to manage complex processes in semiconductor and high-tech manufacturing. So, can India really become a net exporter of electronics? Well, the answer is yes, but it's a long-term goal. We'll need continued policy support, large-scale investments, and a skilled workforce to achieve it. But the momentum is here. Production is growing, exports are also picking up, and big names are setting up their shop here. In the next few years, we might be using gadgets that are not just made in India for local uses, but are also proudly exported worldwide. That's the future we are moving towards. One where India plays a leading role in electronics, creating jobs, boosting exports, and transforming into a manufacturing powerhouse. Now, that was the first story of the day. In the next story, let's talk about a topic that's critical to the future of the global economy, which is critical minerals. Now, these are specific minerals and metals that power essential technologies, from electric vehicles and renewable energy to advanced electronics and defense systems. But the question here is, what exactly are they? Why are they so valuable? And how is India positioning itself in this competitive space? Well, let's first begin by talking about what critical minerals are. These include lithium, cobalt, nickel, and a group of rare earth elements like neodymium and dysprosium. These minerals help produce high tech, energy efficient devices that are now part of everyday life. For instance, lithium and cobalt are essential for making rechargeable batteries like those in electric vehicles. Rare earth elements are crucial in converting energy efficiently, powering devices like wind turbines and smartphone speakers. Nickel is used to make corrosion resistant material for industries like aerospace and energy storage. These minerals are fundamental to the shift towards a green economy. And as nations set ambitious carbon reduction targets, demand for them is skyrocketing. But here's the catch: these minerals are not evenly distributed, with a few countries dominating their supply. In the global market, certain countries stand out as significant players due to their reserves and processing capacities. Well, let's look at China, which processes about 85% of the world's rare earth elements, making it a crucial player in the supply chain. Democratic Republic of Congo, which is DRC, supplies about 70% of the world's cobalt. Australia, Chile, and Argentina hold substantial lithium reserves essential for the battery industry. This concentration creates supply risk. If tensions rise or a trade route is blocked, it could disrupt global access to these minerals, impacting industries worldwide. Now, this risk has driven countries, including India, to diversify sources and secure their own supplies. India recently joined the Mineral Security Partnership, which is MSP, a coalition working to create a more resilient global supply chain for critical minerals, becoming the first developing country to do so. Now, this move signals India's intent to reduce its dependence on imports and build self sufficiency in critical minerals. Jeffrey R. Pyatt, the US Assistant Secretary of State for Energy Resources, noted India's potential as a major player in the critical mineral space, given its large population and growing market. Now, while India has untapped reserves, the MSP membership provides a platform to develop these resources alongside international partners. India's vision is to go beyond mining and become a key player in refining and manufacturing, essentially creating a mine to market model to boost its economy and reduce dependency on imports. India's government is encouraging companies like Tata, Reliance, and Adani to explore critical mineral opportunities, especially as these companies already have a foothold in the clean energy and battery tech. Large scale projects are still in the early stages, but such involvement could position India as a significant player in the global market. India's MSP membership was highlighted during Prime Minister Modi's state visit to Washington, showing the growing US India collaboration on critical minerals. Now, with significant rare earth reserves, India is a promising partner in the effort to diversify away from China's monopoly in this space. India and the US are also working under the ICET, which is US India Initiative on Critical and Emerging Technology Framework, designed to strengthen their partnership in areas like critical minerals, semiconductors, biotechnology, and defense. Although still early, ICET helps India build resilient supply chains, bolstering its manufacturing capabilities and independence in critical technologies. India's move to join MSP and its partnerships with the US are as much about strategic independence as economic growth. China's dominance in critical mineral supply chains poses a risk, especially given India's security concerns and the often tense relationship between China and both India and the US. By building partnerships and strengthening its own capabilities, India aims to reduce its dependency on Chinese supply chains, protect its interests, and ensure a stable supply of these essential resources. Now, the US also sees India as a key ally in reducing its reliance on China, aligning the two countries' goals in critical minerals and emerging tech. Now, this shared interest strengthens India's role in global supply chains while enhancing its strategic resilience. Ultimately, the focus on critical minerals comes down to energy security and resilience. As India pursues ambitious renewable energy goals, relying on imports alone would be risky, and any disruption in the supply of critical minerals could derail these plans, making it vital for India to develop domestic capabilities. India's involvement in the MSP offers a distinct perspective. As a developing nation with significant growth potential, it brings a relatable approach to partnerships across Asia, Africa, and Latin America. This makes India a valuable partner in regions where Western influence may face resistance, positioning it as a bridge builder and reliable collaborator. So, in summary, India's focus on critical minerals is about safeguarding our future economic stability and reducing our own vulnerability to global supply chain shocks. By joining the MSP and strengthening ties with the US, India is positioning itself as a key player in the critical mineral space. Now, all of this is a move towards creating a complete and self sustaining industry to support everything from EVs to advanced defense systems. Now, that was our second story of the day. In the next one, we'll be discussing about ITC's quarterly results. Because ITC is one of the India's largest business conglomerates and it recently announced its quarterly results for the period ending in September 2024. Now, this isn't just financial news for shareholders. Because of ITC's sheer size, its results give us a great idea of what's happening in India's economy. Well, to give you context, ITC's business covers a range of sectors, from cigarettes to FMCG, agriculture, hotels, and even paper products. So, by looking at ITC's performance, we get a bigger picture of trends in these crucial parts of the economy. For this quarter, ITC's total revenue was 20,360 crores. That's a 16% increase compared to the same period last year and a 12.6% jump from the previous quarter. Now, when we look at the profit side, ITC reported a profit after tax of 5,078 crores, slightly up from last year's 4,927 crore and the last quarter's 4,917 crore rupees. Now, to understand what's driving these numbers, let's break it down sector by sector. We'll start with the segment that generates the most revenue, which is cigarettes, and work our way through FMCG, agriculture, hotels, and paper. Now, ITC's cigarette segment is most profitable business. Even with the increasing pressure of rising leaf tobacco costs, this segment has shown resilience. This quarter's cigarette revenue climbed to over 8,000 crore rupees, marking a 7.3% increase compared to the same time last year. But why are the costs going up? Well, there are three main reasons for it. Number one being unseasonal rains. Excess rain during key growing periods has reduced the quality and amount of the leaf tobacco, which is a crucial ingredient in cigarettes. The next one being supply chain delays. Now, delays in processing and transportation have made high quality tobacco pricier. The next one to add to the challenge is the rising export demand. Indian tobacco is increasingly popular overseas, so it is less available for the local companies like ITC. Now, despite these challenges, ITC is still keeping its market leadership. They are recalibrating their prices to handle these cost increase and are also focusing on premium offerings which have been performing well for them. Well, moving on, let's talk about FMCG, the part of ITC's business that includes everyday items like food, personal care, and more. This segment brought in 5,578 crore rupees revenue, which is a 5.4% increase from the last year. But here's an interesting point. ITC's notebook sales surged last year when schools reopened post COVID. That high demand set an unusually high base for comparison, which makes this year's growth look lower even though it's quite stable. Now, to explain high base effect simply, if a business had unusually high sales in a previous period, it can make the current period look weaker by comparison, even if the business currently is doing fine. Now, in this case, last year's rush for notebooks created a high base. If we set aside the notebook impact, ITC's FMCG segment actually grew by about 7%, led by products like Ashirwad Atta, Sunfeast biscuits, and Bingo snacks. A key part of their strategy is quick commerce, a trend where people order essentials through apps like Blinkit and Swiggy Instamart. ITC has adapted its product lineup for these platforms, and although specific numbers aren't provided, it's a growing area for them. Moving on to the agri-business segment, which focuses on agriculture, is a major revenue driver for ITC, contributing around 28% of its total revenue. Now, this quarter, the segment earned almost 5,781 crore rupees, which is a massive 47.1% growth compared to last year. But what exactly does ITC's agri-business do? Well, see, unlike companies that simply buy and sell raw agricultural products, ITC is involved in the entire process. Here's how. Leaf tobacco exports. Now, ITC is a major player in exporting Indian tobacco. It supplies high-quality tobacco to international markets, making this a profitable segment on the global front. The next one is the value-added products. ITC also processes and packages agricultural items like coffee, spices, fruits, and vegetables. Now, these aren't just raw exports, they are tailored to meet global standards. The next one is the farm level partnership. ITC works directly with over 7.5 lakh farmers across India. By teaching them climate smart farming practices, ITC helps these farmers grow more resilient, higher quality crops, which benefits both the farmers and ITC. So, by investing in climate smart agriculture, ITC ensures a steady supply of quality products, secures long term relationships with farmers, and strengthens its place in both domestic and international markets. Let's then move on and talk about ITC's hotel segment, which reported a 728 crore rupees in revenue for this quarter and showcased a 12.1% growth compared to last year. This growth is even more notable since it comes after a strong previous year, which saw a spike due to events like the G20. Several factors contribute to this growth. Number one being better occupancy and revenue. Now, higher room occupancy and improved room rates have boosted the revenue. The next one is its asset-light model. Rather than owning hotels outright, ITC focuses on managing them. Now, this approach, known as an asset-light model, has allowed ITC to expand quickly. In the last 2 years, ITC has added 30 properties to its portfolio. Number three is the international expansion it is looking at. ITC recently opened its first international hotel, ITC Ratnadeepa in Colombo, Sri Lanka, which has already received positive feedback. ITC is also in the process of demerging its hotel business. By doing this, it can focus more on the core businesses like cigarettes and FMCG, while shareholders benefit from the potential growth in the hospitality sector. Now, lastly, we have ITC's paper and packaging business, which earned almost 2,100 crore rupees this quarter. Now, this segment saw just a 2.1% growth from last year, and it's facing a couple of tough challenges. Number one being the cheap Chinese imports. Low-cost paper products from China are flooding the Indian market. This makes it harder for ITC to maintain profitable pricing. The next one is the rising wood costs. Unseasonal rains and stricter environmental regulations have driven up wood prices, which is a core material for paper products. Now, these factors are squeezing profit margins, meaning ITC's earnings from this segment aren't growing as quickly. But ITC isn't sitting still. They're working to reduce these pressures by increasing exports and improving cost management. So, in summary, ITC's latest results give us great window into the state of multiple sectors in India. Cigarettes, its oldest and the most profitable business, remains a stable contributor despite rising input costs. The FMCG and agricultural segments are growing up, showing that ITC's approach of mixing staple products with quick commerce and value added agricultural exports is paying off. The hotel business is strategically expanding, while the paper segment is fighting challenges from both international competition and rising costs. In every segment, ITC is adapting, whether by focusing on premium offerings, leveraging farmer partnerships, or expanding into international markets. This resilience and adaptability are why ITC remains a strong indicator of economic trends in India. And with that, that was our last story for the day. But before we wrap up today's daily brief, let's look at some interesting tidbits. Number one, India plans to build 50 new airports to strengthen connectivity and meet rising air travel demand. With air passenger traffic set to double in 5 years, this expansion targets job creation and long term economic growth. Number two, Swiggy has reduced its IPO valuation target to 12.5 to $13.5 billion, adjusting to the market volatility. The IPO, aiming to raise $1.4 billion, reflects strong interest but cautious investor sentiment in India's IPO market. Number three, JBill, an Apple supplier, plans to invest up to $275 million for two new facilities in India, expanding production of components like AirPods and iPhone casings. This highlights India's growing role in global electronics manufacturing space as well. And those were the big stories of the day. I'm your host Bhavya Dua, and this was today's Daily Brief. See you in the next episode.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.